Hello and welcome to Trading Blows from TraderX. A big show ahead as we digest a monster week for the markets last week, and across the panel look at where we now stand and how to trade the market that lies ahead of us. We've got a few interesting and exciting topics to discuss. US data coming in very, very surprisingly to the upside last week. We discussed whether the US is now on course for a soft landing, still on course for a hard landing, or perhaps even on course for no landing at all. We look at the policy decisions last week from the Fed, the BOE, and the ECB and how their respective outlooks are likely to influence the FX market. We take a look at stocks and see where they may head next, where treasury yields are going to go as the market prices in a 5.12% terminal rate from the Fed. And we also look over in Japan how the next BoJ Governor could impact the Japanese yen. Without further ado, let's get into it. So, a big show ahead. Let's meet our panelists who are going to go head-to-head over 4 rounds, as always, scoring points for a great response. And if they give us some actionable market trading ideas, they will get even more points for their answer. And of course, there is always that threat of points being chalked off if a dispute is raised over what they say. Joining us this week, Arno, market analyst at Financial Source, David Belle, the founder of Macrodesiac, and Richard Matthews, the founder and managing director of Pardus FX. Let's crack on with round one. Well, we had some incredibly surprising data out of the United States on Friday. It was a little bit of a bolt from the blue. The payrolls number coming in at 517,000, way above, almost 3 times above what economists were expecting. The unemployment rate at 3.4%, its lowest since 1969. And then following on from that, shortly afterwards, we had the ISM Services PMI printing 55.2, a brilliant number, no matter which way you judge that metric. So really throwing a bit of a cat amongst the pigeons when it comes to most people's views and consensus calls on the US economy. So do we now think that a soft landing is the base case? Do we think that perhaps the US economy is going to experience no landing at all? And how do we trade those themes? Arno, let's kick off with you.
Yeah, so I think hard landing is still the highest probability right now. I mean, look, those data points were immaculate, right? Very, very high prints coming out. But I think the risk here is that the markets latches on to very short-term 2 data points, basically, instead of looking at the aggregate of the data. So if we consider the aggregate of the data over the last couple of months, we've clearly seen the leading indicators starting to slow down and decelerate quite a lot. If you take a look at housing, business and consumer sentiment and confidence measures, activity data, even retail sales, it kept up okay, but year over year, we're starting to roll over. And I think the only reason why things like retail sales have really kept up is because consumers have relied on short-term credit or potentially drawing down their savings to try and keep up their spending habits, basically. So I think if you look at the aggregate of the data, a hard landing right now is still the highest probability. The risk to the hard landing view, though, at least let's say in the first half of this year, is that the labor market has stayed solid for much longer than anybody anticipated. And it's given those leading indicators that's been decelerating over the last 12 and 13 months, it's given them a chance to bounce. So if you take a look at mortgage applications, they've bounced, pending home sales, new home sales, the NAHB, obviously Friday's activity data as well. So you're starting to see a bounce in those soft data points. And if you look back to 2008, we had a very similar situation in other cycles as well, where you had the leading indicators decelerating a lot. And then there could be 2 or 4 or 6 months when those short-term or leading indicators bounce. And I think that bounce can start feeding into a soft landing narrative. But when the labor market starts to roll over, and I do still think it will, it's going to lead to a hard landing still, in my opinion.
So how would you, we'll come to the rest of the panel in a second, how would you position yourself for the hard landing scenario? What would you be doing? Would you be fading the strength that we see in the equity market? Would you be buying treasuries? How would you play it?
Right now, I think the danger is that the soft landing narrative continues because we see a further bounce in those soft data or the leading indicators. So in my opinion, the best way to play this, and we'll touch on that, I'm sure, later, talking about the FOMC as well. But I think, in my opinion, short term is the best way, mate. Looking at the data, finding a clear edge in how you think the data will respond, how different asset classes will respond to that data, and then trading that in the short term. I think this is really, it's a trader's market right now, not an investor's market.
No, I think you're absolutely right. So very much the sort of one swallow doesn't make a summer camp from Arno in terms of data and a soft landing. David, what are your thoughts on the whole situation?
I've never heard of that saying, one swallow makes a summer camp, before in my life. In terms of the situation,
it's not summer camp, it's just summer.
I think the main thing for me is really looking at the terminal rate and where that shifts to, and looking at what the pricing is and where that terminal rate is, finally going to end up. But it's less about the number, I think, and more about the movement. So based off of last week, for example, something interesting that happened, if you look at the countdown to FOMC, and this isn't obviously indicative of where it will actually be in the end, but it's indicative of what the market thinks sort of right now. If you look at the June meeting odds, okay, for 525 to 550 basis point target range, the odds of it being there at June a month ago was only 9%. A week ago, it was only 2.1%. But as of right now, it's at 33% versus 500 to 525 basis points, which is at 49.8%. So I think that data from last week has really, really shown a much more hawkish tone than even I think the market is picking up on right now. And for me, that's really the key. Arno mentioned the labour market, and I think he's bang on. The labour market has stayed so resilient. And in terms of an economic indicator, I think that has to be the one that turns over, that decides whether we'll be, facing a soft or a hard landing. Personally, I think the labour market is going in the same way that equities go, where, tech stocks sell off first, higher beta, and obviously then those jobs are being lost first. Now, what will be really difficult for the economy to take is when those real economy jobs are lost. Not that tech jobs aren't real jobs, but, let's face it, they're heavily stock-based. Most are probably quite superfluous, if we're being quite honest. And, when we start losing manufacturing jobs, the real output jobs, then I think that's when we really face the hard landing scenario.
No, I would agree with that. Dick, let's bring you in. Would you agree with that? We need to worry about the labour market and start worrying about the market more broadly when we start to see jobs in the real economy and industry rolling over?
Yes, I think that's broadly correct. But what I think is interesting is that everyone's looking at one set of figure or looking at the labour market. We've never seen a labour market like this. We've never experienced COVID before. We've never had a complete shutdown of economies. And I think the labour market's probably distorted. And there's some interesting numbers in there. The number of immigrants getting jobs, which are obviously lower paid jobs. I think COVID led to a big dislocation of people all over the world, in America. And I think it's very, very hard to read too much into that labour market. Regards to a soft landing, I think that the planes come in, had a look at the flight path and taken off again for another circuit. So I think we will end up with a hard landing. I think the Fed will over-tighten. I think we'll see 5.25% in the middle of the year. I don't think that they're going to ease. So I think we will get a hard landing, but probably not until the back end of this year. But all in all, the labour market does look amazingly resilient. The jobs are still very high. Was it 1.9 jobs available for every person applying for a job? I think that it's going to stay pretty tight. My long-term bet would be for a hard landing, and I would look to fade equities. But when is the good question. I think it's really, really hard to be short at the moment.
I think as well, another big risk is looking at for a hard landing scenario, especially is looking at the data points that contributed to CPI staying sticky last year and the year before, because I've just seen that used car numbers were coming down quite a lot, but in the last month or two, they've ticked up quite heavily. And that was a major sticking point at one point, I think, in 2022, keeping inflation up near that. I think it was about 7.5%, 8% mark when other markers had and other constituents of CPI had dropped. So if demand is getting stronger in the used car market, obviously that's going to have a higher weighting in the CPI basket. So that's definitely something to watch for, considering, the prior precedent of that keep inflation buoyed.
No, and I mean, it's not just that, commodity markets they're off their highs considerably. If you take a look at especially those that's more linked to China, to the reopening trade, they've shot up. And I mean, if you just look at some of the nowcast models, I don't know when last you guys had a look at the Cleveland nowcast, but they are pricing in a fairly sticky number going into next week. So, the worst case scenario would be inflation slowing a lot slower than what the Fed thinks that it will, that disinflationary process staying basically flat and then growth starting to slow. That could lead to, depending on how fast inflation falls, the depth of that hard landing could be, quite something to observe in the months ahead if inflation stays where it is now, or at least just falls a lot slower.
Yeah, indeed. Well, you mentioned the Fed. Let's dig into the Fed in a little bit more detail in the next round. So the FOMC, probably last week's main event, if you looked at the calendar beforehand, pretty much going as we would have expected, a 25 basis point hike, which every man and his dog was calling for, and the market had pretty well discounted in advance of the meeting. The guidance in the statement also pretty much unchanged, with the repetition of the line that ongoing increases will remain appropriate in the coming months. I guess the real question is, and I'll start with you, Dick, as I know this is something that we've discussed at length before, is, when do the markets really start listening to this and actually believing the higher for longer narrative? We heard Powell again on Tuesday repeating broadly similar sentiments, and the market again largely shrugging that off. And at what point does the market really wake up and smell the coffee and start to build bullish dollar positions on the back of that?
I think it's fascinating how the market turns its narrative against Powell. I thought he was moderately hawkish after the FOMC, and I thought he was moderately hawkish yesterday. But then you read the press, oh no, he's turned dovish. Everything's okay now. I think when the market turns is when you get a uptick in inflation, which no one's looking for. I think the Fed's data dependent. They don't understand the data, and that's not me decrying the Fed. I just don't think, as I said earlier, anyone's ever been in this situation before, and putting your dependency on data, which is completely raw, is wrong. I think you're going to see an uptick in inflation. At that point, people will go, my God, they're right. We are going to stay higher for longer. And I think people looking for a cut at the back end of this year are fundamentally wrong. But I've been saying that. And as you know, you can only turn against the market for so long before you get run over by it. So God knows when people actually realise that he's serious about things. It may well be when you get a surprising uptick in inflation.
Yeah, no, I think you're right. The Fed are data dependent, so we need to be data dependent as well when we're making market views. David, what about you? We obviously got that inflation print coming up next week. Do you agree with Dick? You reckon inflation turning might be the catalyst to give the dollar a bit of impetus once more?
Yeah, I mean, I thrive in a dollar bull market, unfortunately. I do absolutely awfully when the dollar's coming down, generally. So I desperately want the dollar to turn back up. And it has been. It's been good the last week or so. I've been selling the Aussie, got knocked out of my pound short, which is it's kind of the same trade, but not really. So I got back into the Aussie, which is good. But yeah, I think we started seeing a lot of FX analysts when the euro was back up at like 1.09.5, saying, "Oh yeah, here we go. The euro's on a run to 1.15. The market's pricing in more of the interest rate, the terminal rate, basically." And then we saw the turn, which was lovely on the Thursday last week. And I think, the market is still very much getting into exuberant territory, similar to 2021, 2022, off of nothing. It's just not the same context. You're seeing rallies from squeezes more than anything. And yes, it comes down to, interest rates and the Fed being priced in more and more, but really you're just not in the same context. And anyone talking about a broad-based rally here and the Goldilocks, I'm sick of I'm sick of the term Goldilocks. If I hear it again, I'm going to shoot myself, basically, because at the end of the day, assets are priced relative to interest rates. Okay, interest rates are the barometer of asset prices. You cannot sustain the kind of businesses and equities that we have that dominate stock markets at the moment with a 5% base rate. You simply can't. So people calling for longer term rallies are just crazy in my view. Of course, it's difficult just to play the short side in bear markets because you get rips up and you get people saying, "Oh yeah, this is the turn, this is the bottom," but it's just not possible. So I think people that are trying to sell the dollar as much as possible are just going to get blown out of the water.
So fade dollar strength, fade equity strength. Arno, would you be on board with that view?
Yeah, totally, mate. I think right now it's all about the data, right? The risk here is that there's so much focus on where the Fed is going to be at the end of the year from the market and where the market thinks the Fed will be. But at the end of the day, right now where we're trading, that doesn't really matter because the data is going to guide us there. The data will tell us whether we have a higher probability of a soft or a hard landing. If we see a higher probability of a soft landing, that's probably going to see the markets taking that one cut currently that is priced for the end of the year, pushing that out into 2024. And if we see the data coming in super ugly, that's probably going to see the markets pricing in maybe 2 or 3 cuts by the end of the year. But it's all going to be based on the data. In the broader scheme of things, that means that from a cyclical perspective, I think you have to remain constructive on the dollar and you have to view equities as a sell on rips. However, the short term, like Dave said, that's the real key here. I think, like we mentioned in the prior point as well, it's a trader's market right now, not an investor's market. So I wouldn't want to be somebody that has to allocate big capital right now to stocks and bonds and FX because it's just so messy. Now, I think right now, the retail community that can be very nimble is actually in a good environment because I think that's the best way to trade this. To try and allocate yourself now for where we think the federal funds rate will be at the end of the year, I just think that's dangerous. I think it's far more simpler to trade in the short term, looking at the data, and trading it short term out of the data. I think that's really the cleanest edge that I can see in the markets right now.
No, I would totally agree with you on that. But, the being nimble is the key here. But I'm going to ask you the question anyway, because let's make things interesting. Where do you reckon the Fed funds rate is at the end of the year, Arno?
Right now, if the soft data, like I think it will, running into at least the half of this year stays, if we see that bounce in the soft data, which I think is the higher probability right now, I think we're going to be very close to 5.1, 5.25 by the end of the year.
And Dick, what about you?
I agree with Arno. I think it's going to be 5.25.
Too much agreement on this panel today. Let's see if we can have a bit of a disagreement and heated debate in the second part of the show. Let's get on to round 3. So we've covered the US in quite some detail so far in the show, and we've also had rather too much agreement on the panel thus far. So let's try and shake that up a little bit in the second part of the show. Let's get over to Europe and have a look at European central banks. The Bank of England and the ECB both raising rates by 50 basis points last week, but that was probably the only similarity between the two central banks. The guidance that the two issued probably couldn't have been more different, really. The Bank of England pivoting to a more dovish stance, removing the reference to forceful action from their statement, while the ECB in their statement, in the press conference, if you could make sense of the riddles that President Lagarde was speaking in, and also in subsequent speeches, signalling that they're going to be tightening policy and hiking rates well into the spring. Who do we think's got this right? Who do we think's got this wrong? And what's the best way to trade not only the divergence between the two, but also the policy outlooks from those respective central banks? Dick, I know you want to get your little BOE rant in most likely, so let's get that out of the way first, shall we?
I love the Bank of England. They're so good. They're so good. I'm trying to work out how I can say Goldilocks when I'm talking about the ECB or the Bank of England, but I can't think of a way of using it, which is very, very irritating. Well, the ECB said what it's going to do, and it's done it. And I think you're going to get another hike upwards, despite, I think, things slowing down in Germany. It's rather strange to see pushes from elsewhere to tighten rates not coming from Germany. So I think that they're probably right in what they're doing. Schnabel came out yesterday. It was quite tough. I think Nott's talking later on today, and I expect that he's going to be tough as well. And that's sort of disregarding what they said at their interesting press conference. I think that's probably the best way to describe it. And the Bank of England, to me, just still seems a mess. I think they're trying to talk tough. I don't think they will be tough. I think you may actually see the terminal rate that they're going to get to. We may have achieved that already. Certainly, looking around, inflation's still very high over here, and I don't see how they're going to control it. I think they're in for nasty shocks, but I don't think the appetite's there to raise rates any higher. Whether that's political, I don't know. Certainly reading Truss over the weekend, she was inferring that the Bank of England could be a little bit political. I'm not sure whether that's fair or not. I think the Bank of England's done. I think the ECB will raise again, and trading it. It's almost like cheering for Spurs over the weekend saying this. I'd buy the euro and sell the pound, and that's contrary to all my gut feelings. But I've said it now, so I'm going to have a glass of water.
Well, you've been long euro sterling for some time, and it's been working out for now. David, by your reaction, is that this is the worst trade idea I've ever heard, or is that a reluctant agreement with Dick?
No,
it's
it's unfortunately a reluctant agreement. I just came back from Iceland on Sunday, and as I was landing, I got an instant pang of anxiety as the plane's wheels touched up. No, just being back in England in the state of the country. Like, since Truss's ousting, I've been totally dejected at the competency of anyone in establishment, whether it's a politician, the Bank of England, whatever, because the media as well. Jesus Christ. I've never seen a prime minister get ousted by media as quickly as trusted. She was totally wrong on the timing of introducing the policies, but they were absolutely the right policies to go for if you consider the context of what other countries have done. And I'm going to get onto that in a second. But yeah, I just felt absolutely sad again to be back, unfortunately. And it wasn't just holiday blues. It was, oh God, this place. But the context that I was talking about just then, and rather than speak about the ECB here, I'd rather go on to something mentioned back in March last year, coming out of the European Commission, which was at their spring, I think it's called their seminary or something like that. And basically, they had suspended their fiscal rules. And the fiscal rules of, I think it's negative 2.5 or 3.5% of deficit GDP spending. You can't breach that, basically. And also the government debt GDP also has to be limited. But these have been suspended for a while now, and they're going to have to be reintroduced. So rather than focus necessarily on the ECB side of things, this other factor that could come into play is probably a greater risk to markets and, probably more pertinently to the Eurozone economy than just the ECB, because it's a massive factor that's been out of the kind of oversight and the market's perception for a good while now. And when they start talking about these fiscal rules having to be reintroduced, it's going to put eyes back onto that data. We saw back in, I think it was October or November, and this is relating more to Truss now, that Germany has 360 billion euros in off-balance sheet debt, which are in 25 different funds. So this is outside of the normal budget. If you compare what happened to Truss, where, the apparent black hole was a third of that, versus Germany, why all the furore over Truss and no furore over Germany? Which is why I said it's trial by media. They don't understand much beyond their noses, or much of anything, to be honest. They understand the smell of parts, and that's basically it.
So how would you how would you get exposure to that theme in the market then? Would you be looking to get short of European assets now, or is this sort of a longer term theme that you think will play out over the course of the year?
Well, I think the obvious play would be to, and it's a combination of the monetary policy as well, would be to sell the DAX. Germany is well known as being a corporatist, fraudulent toilet. If you look at the emission scandals, Wirecard, if you look at the relationship with Gazprom and Schroeder, it's very, very much an economy built on opacity and political cronyism, which doesn't really come to light that much. But when interest rates go higher, that opacity tends to come to light because something breaks. And I think we're going to see more of that with Germany. Deutsche Bank offices over there get raided every other day. And I think that the DAX is one of those indices which really is very much overvalued. They added 10 more companies to it to make it seem a little bit better than what it is. But it's just a reflection of German corporatist fraud, basically.
So we've got a reluctant... Oh, sorry, go on, David.
So just to interject, interesting to hear you talk about Germany, which I must admit you're putting an open door here, but compared to France, they are white and white. Rules are made to be broken in Europe, and fiscal rules certainly, and I'm surprised that you think they'll pay any attention to them.
Well, I think the difference is that there's a lot more. So Poland and Hungary are pushing back against the EC and how they treat Germany quite heavily. And I think the Ukraine war has put a lot of eyes onto how Germany has behaved when they've really gotten away with stuff. So, not providing adequate help at the right times.
Sending helmets.
Exactly. There we go. And I think, while Poland and I believe Hungary's helped, but Poland's helped a hell of a lot. I think they're the third most country after the USA and UK that have helped Ukraine the most. I think the eyes on Germany are shifting, and the fact that they can't get that cheap natural gas anymore from Russia as easily, they can still get it, is going to affect, their production quite heavily as well. Cozying up to China isn't probably going to be the best site as well, while the UK is trying to join the CTPP or CTTPP, whatever the hell it is. So I think there's a lot of things at play there where Germany's going to be affected, which, directly affects the EC. It's not one of these situations where you're saying, oh yeah, the EU is going to break up. But I think from a perspective of, okay, who's actually looking weak geopolitically, who hasn't really faced much fire, I think Germany's there.
You take Germany out of Europe, you take the engine out, don't you? You could argue.
Exactly.
I want to bring you in, Arno. Forgive me, you're going to have to keep your answer brief because I'm going to get told off for making this show too long again if you don't. We've got a reluctant Euro bull and we've got a DAX bear. Where would you sit on this spectrum? Would you be in line with either of those views or taking a totally different stance on things?
I mean, if we're talking only ECB and BOE, I quite like medium-term euro sterling downside, actually. I know that goes against consensus, but I'm more thinking about what the markets have priced for these two banks. In terms of the UK, right now, a long, hard, super deep recession is pretty much our base case, right? That's the baseline. So I think that in the weeks ahead, if we see economic data starting to improve for whatever reason, I'm not saying it's going to happen, but I'm saying that I think there could be some asymmetry there, because if a super deep recession is your baseline, if we just get data that is marginally okay, that could see some upside risk for sterling versus the euro. And apart from that, if things get so bad, let's just say the data doesn't improve and things get really, really, ugly, how quick that can see the BOE pivot to potential cuts. I think in the medium term, like we spoke about this last week, I think that could actually be sterling positive, because right now I think the focus isn't so much on how much the Bank of England has left to hike. I think the focus is more on what needs to happen to see an improvement in the economy, what needs to happen to see the markets going from very bleak economic outlook to something that is slightly less bleak. And I think that means that there's a few avenues where sterling can actually see some upside in against the euro. However, we would need to see the ECB starting to just turn slightly more dovish. There is still a lot of hawkish expectations. I think the one thing to note, though, about last week's ECB is they said that they think when it comes to the inflation outlook, the risks are now more balanced. I think that is a way for the governing council to tilt more dovish from here, not more hawkish from here. It seems like everybody thinks that they're going to go even more hawkish than they think they are. And I think the risk here is to the other side, where they actually need to go more dovish than what everybody is currently pricing them in to do.
No,
so not tradable right now, but I'm staying patient with it. But I think euro sterling downside in the weeks ahead, depending on how the data comes in, could be interesting.
No, I think that's a really interesting view, and purely from a selfish point of view, I would quite like that to happen as well. Without further ado, then, let's get on to the final round of the show. So continuing our little mini Trading Blows world tour, we've done the US, we've done Europe, we've done the UK. Let's now do Asia and have a look at Japan. Obviously, the yen having this big pop lower at the Asia Open on Sunday night / Monday morning, despite people trying to dispute the fact that happened in my Twitter mentions over the weekend. The reason for this being the Nikkei reporting that one of the deputy governors at the BoJ, Amamiya, is going to take over from Kuroda when his term comes to an end in April, I think it is. And there is an expectation that we get an announcement on this decision relatively shortly, which should see a wave of ABBA puns unleashed on social media. I guess the bigger question is, from my point of view at least, what is the biggest driving factor behind the yen at the moment? Is it the new BoJ governor and what they do with policy? Is it global risk appetite? Is it where treasury yields head and how the Fed outlook evolves? Or is it something totally different that I might have missed off that list? And where do you think the yen goes next? David, let's start with you first.
Simply, I don't know, but the more probabilistic outcome is they're going to do the same thing that they've done for the last 20 odd years. They're almost at a situation where they can't really diverge too much from what they've been doing. They can alter the cap, for example. They can do all of those things, but they're just too down the rabbit hole. I don't really have that much more to add on the BoJ because they're almost entrenched in what they're doing. I think if we do see some kind of, honestly, I don't know. I'm being totally honest there.
No. I mean, I think one of the most important things to do as an analyst or a trader or a commentator is when you don't know, you say you don't know. I just want to pick up on that point you made though, and just expand a little bit. The BoJ, they are absolutely entrenched in ridiculously dovish monetary policies. You can raise the yield cap, you can hike rates 10, 25 basis points, probably not much more than that. But taking that into account, and we'll just stick with you for a second, David, do you think that means that actually the biggest driver of the yen isn't the Bank of Japan, and we should be looking at where treasuries go next, or if stocks come lower, we buy the yen as a safe haven? Do you think they're bigger influences on the currency?
Perhaps, but you could probably look at the actual opposite relationship between what Japan is doing and US treasuries. Japan is the largest holder of US treasuries. Many think it's China or someone else, I don't know. So a lot of activity actually to do with Japan affects US treasuries in a certain way. I don't necessarily know what relationship there would be or what the driver would be, but a lot of pension funds are involved in US treasuries from Japan. So that could be one relationship to look at. But in terms of, dollar and yen dynamics, we've really seen the big moves off of dollar and yen being from the intervention recently. We had that sustained dollar weakness through 2022. I think when we did that talk, when you where were you previous? No, you were.
That was back in June time, wasn't it? June last year. Yeah.
So when we did that, I think the dollar yen was trading at like 124, something like that.
Yeah.
And a couple of targets above were 130 and 140. Breezed through those. So I think the dynamics really have just been a really strong dollar, but then the Japanese, the Bank of Japan, having to intervene. Yeah. So it's a weird one. There's not really been much to latch onto as to what the drivers are, really. And it's not one I've played that much recently. I did a little bit last year, but this year in Q4, not at all. There just hasn't been anything sufficient for me to grab hold of.
No, good stuff. Dick, let's go to you, because currently the wooden spoon is heading your way. So let's see if you can get a chance to claw your way off the bottom of the leaderboard. What are your thoughts on the whole Japan situation? Is it even worth talking about BoJ policy if it's not going to be a huge driver of the FX space?
Funnily enough, actually, I do tend to agree with David. I don't think that the BoJ policy is the biggest driver. I actually think it's outside influences, the US Treasury market. And if you see some softening there, you'll see the yen appreciate. The couple of things which I've noticed, that the pay rises in Japan, and Nintendo, I think yesterday raised their pay by 10%, and Uniqlo also recently raised wages quite high. Whether that's an influence by the Bank of Japan, soften things up, get some inflation in the system, which they had tried for 20 years to do. Whether it's actually coming in, I don't know now. I'm not convinced that I can't pronounce the name even, Anna Maria, I was going to say, which I shouldn't. Maria.
We know who you mean.
The Yamaguchi is my firm baby, which is a much nicer word. Will change policy that much? I'm not so sure. I think it's actually outside influences will drive the yen. And whether that's probably the US more than anyone else.
So would you say dollar yen's got room to move lower from here, or are you bullish?
Yeah, I would think it's going to move lower.
Good stuff. And Arno, let's wrap up the show with you. What are your thoughts on the whole Japan situation? I'm sure you've got an interesting view on things.
Well, I wouldn't really call it interesting, but I think what Richard said is really, I think that is what we need to focus on. Obviously, treasury yields are always going to be important for the yen via that inverse correlation. So yield differentials will still play a role for the yen, but something structurally, I think, is starting to change in Japan. If you take a look at the comments that we've heard from the government, they are really, really serious about wages being picked up. We had the government putting in place various policies trying to get companies to raise wages. We had Fast Retailer coming out, what was it, I think 3 or 4 weeks ago, saying that they could raise wages by up to 40%. Now, obviously, it's not going to be 40 across the board. They reckon that the average increase in wages will come in about 15%. Now, that's massive. For a country that hasn't had inflation in 40 years, we have the highest inflation right now in 40 years. We're trading at, 4.2%. So I think wages is the real risk here. I mean, whether it's going to be Yamaguchi or Amamiya, I hope I'm pronouncing that okay, whether it's going to be one of those two, I think that only changes the timeline of when something could happen. And when I say, something, I don't think they're going to follow the path of other central banks, even like the SNB. If they're going to do anything, it's going to be super marginal. They're literally just going to try and get away from ultra easy policy. They're going to normalize. They're not going to, go aggressive or anything like that. But I think what we should focus on for the first time in many, many, many moons is focus on the economic data. Wage data, we came in at 4.8% yesterday. I think that's the highest going back to 95. And okay, it's worth noting that the spike we had in wages, we had a similar spike in 92 and I think in 96, and both of those mean reverted fairly quickly. So just because wages are, trading at a 30-year high doesn't mean that it's going to stay there. But I think that's where the risk is. The risk is that we actually do get some inflation that is, it doesn't need to go the US route for them to just normalize a little bit. Again, like Dave and Richard said, how much they can do, I don't think they can do much, but the little they can do will already be a big step away from the ultra easy policy we've had for, since forever.
Yeah, no, I think you're right. And I think it's an interesting one that Japanese economic data is starting to get exciting again, isn't it? Well, that brings us to the end of this week's show. So let's have a look at the leaderboard. Well, you can hear Dick sighing in the background, and that's because he has got the wooden spoon this week, unfortunately. So I'll be heading off to Mayfair in a second to go and deliver that to you, Dick.
Thank you very much.
David coming in just behind Arno. Arno with 12 winning this week's show. Congratulations, mate. Well done. Feel free to thank your family if they care.
Yeah, I don't think they will, but thank you. I will extend that that celebration to them.
We'll get a rosette or a gold medal or something sent down to South Africa for you. Good stuff. Well, thank you very much to all three of you for joining me this week. Arno Venter from Financial Source, David Belle from Macrodesiac, and Richard Matthews from Pardus FX. Links to all of their social media and websites will be in the video description. Thank you very much as always for watching. We hope to have given you a good show this week and look forward to seeing you again soon. Thanks again and goodbye for now.